Welcome back to SmartWealth Radio with Altmaier and Minnick. I'm your host, Steve Minnick.
And this is Dave Altmaier.
And this is the show where you're learning to be smart about the health of your wealth. Well, if you hear something, and I think you will today, that you're interested in and that causes you to say, I got to learn more about that, make sure you call us at 509-32-SMART. That's 327-6278, and we'll make sure and get the information back to you that you're requesting. Well, Dave, we are very privileged to have in our studio today David Morgan. David is the author of a newsletter called TheMorganReport. It's a monthly e-newsletter, and he also gives a personalized coaching to folks that want to invest in silver or gold or mining stock. And we're very, very pleased, David, to have you in the studio today. Thank you for being here.
Oh, that's a pleasure to be here. Thank you for inviting me.
You know, one of the things that Dave Altmaier and I do on our radio show is to make sure that people understand that if you have all of your money at risk in the stock market, then you're really not diversified. So we strongly believe that it's wise for people to spread the risk out over future income streams and, stocks, bonds, commodities, whatnot. And Dave and I live in the world of the brick house. So we are the safe future income strategies. But we also recognize that many of our listeners have a very strong interest in learning more about these other kinds of investment strategies, real estate, etc. So just right out of the gate, David, why would our listeners be interested in hearing what you have to say about investing in silver or gold or precious metals of any kind?
Well, first of all, if you go back into history and you look at, what monetary system has survived, it's always been the precious metals. I mean, this is what the free market is determined to be money. So there isn't really one paper currency on the planet that's really gone much more than a couple hundred years. So you're saving in bonds, you're saving in a bond of a corporation or perhaps a government. It could be the U.S. government. It could be the Bunds Bank. It could be the United Kingdom. It could be whatever. But the long tail of the situation with the monetary system is that it's always broken down when it's based on an interest payment that cannot be given into the indefinite future. So let me restate it slightly. Compound interest, as Warren Buffett has stated, is like the eighth wonder of the world. And it truly is. However, at a certain point, it goes exponential. And one of the failures of mankind is to understand the exponential curve. And because you can compound at a certain rate, it gets away from you at a certain point in time. And actually, we have reached that point in time with the United States debt and many other countries around the world. So because of that fact, you need to hedge your bets. I'm not saying the stock market's good or bad, but the most negatively correlated asset to the stock market is gold. Nothing moves more strongly opposite to the direction of the stock market than gold. Now, notice I said gold and not gold stocks. Gold stocks are stocks, and they generally move with the stock market initially if there's a crash or correction, or depending on what the economy is doing, they sympathize as stocks, at least initially. Whereas gold is a safe harbor asset, a safe haven, if you will, and that has a propensity to go the opposite direction. If you go back to the 2008 financial crisis, gold did sympathize with the general equity market and the bond market, and of course the real estate market with the subprime mortgages. But the first one out of the gate to turn around were both gold and silver, and they went strongly north when everything else was still wallowing around and not doing very well. So that's my answer. It's an asset that goes the opposite of the other two, stocks and bonds.
The reason I've heard that it goes down initially with the stock market is a lot of hedge funds or funds hold it and they dump the good asset first. So they dump it and there's nobody there to buy it because there's lack of liquidity. And then when people have the liquidity, then it takes off.
I think that's exactly right. I mean, this has been shown time and time again, whereas a fund manager, they're always leveraged. And so they look at what they have that's in the positive zone. It's usually gold holdings of some type. It could be the GLD, or it could be a gold mining company, or it could be whatever, but it's gold related. And that's the best of the worst. So they have to liquefy that. It's the most liquid. And certainly, if it's all sell orders and very few buy orders, it is going to go down in price. But again, it will pick up, or has, at least history has shown, picks up much sooner than the other asset classes because it's a different asset. It's really outside of the system, if you will, especially a gold coin, for example. There's no broker, there's no counterparty risk involved whatsoever.
Well, if our listeners are just joining us, we have as our guest today David Morgan. He's the publisher of The Morgan Report. He's also appeared on CNBC and Fox Business and BNN in Canada. He's also been interviewed, Wall Street Journal, Futures Magazine, Gold Report, and other numerous publications. And he has a book here in the studio with us today. In fact, I see several copies. We're going to be giving away a copy to the first 3 callers. You need to call in to 509-32-SMART. That's 327-6278. This is a book that David wrote with Chris Marchese. It's called The Silver Manifesto. So if you listeners have an interest in investing in silver or silver stock, this would be a great time for you to call in 32-SMART. That's 327-6278. So before we take a break, David, give us a little bit of your history. I mean, how did you become the silver guru?
That's quite a story. Before I move on, it might be best to let the audience know that although silver is my specialty, the Morgan Report, our monthly financial publication, looks at money, metals, and mining. So we look at the resource sector as a whole. So we do a lot of things outside of the silver and gold industry itself. But I was interested in money as a kid, and when I was 11 years old, we went from what I call the 90% silver backing or silver coins, dimes and quarters, half dollars, to what I call the Johnson slugs, and that happened in 1965. And even as a kid, I realized that these 2 quarters that I had just couldn't be the same. One was like something that looked silvery with copper in the middle of it in a sandwich form, and the other ones that I had collected from doing yard work were pure, were 90% silver. So it struck me, but it seems that none of the adults really noticed it. And that was just kind of the beginning. That certainly didn't start off my fire in the monetary system thinking, oh, I'm going to be the silver guru. And of course, I say that with tongue in cheek. But that was a start of my quest about what is money and why did it change? That was my question. So that kind of stayed with me for quite some time. And then, of course, as I grew older and got into finance and went about learning about the stock market, et cetera, just one thing led to another. It's just been a passion. It really is. And still, you can probably feel in my voice, something that I still get up in the morning thinking about it. And I like to teach about it, and I like to make my living talking about the markets in general, but particularly the precious metals.
Well, we're honored to have you here. And listeners, if you'd like to get a copy of David Morgan's book, The Silver Manifesto, make sure you call in 32-SMART. That's 327-6278. And we have a ton of questions for David today, and we'll cover those after the break. It can be difficult to know the best way to manage your wealth. Hi, I'm Steve, co-host of SmartWealth Radio with Altmaier and Minnick. I help my clients relieve the stress over growing and protecting their wealth. Frank and Joella are so happy they wanted to share their story.
We lost a fair amount of money in the stock market. For us, we lost about half of what we had saved. Now, granted, we did get most of that back over the years, but at 65, we thought there's no way we have the earning capacity to replenish that. So we found Steve.
We've been relaxed because what he showed us and presented to us is really a no-risk deal.
Frank and Joella, thank you for your kind words. Call me today, 509-32-SMART. That's 327-6278. Helping you to be smart about the health of your wealth. Welcome back to SmartWealth Radio with Altmaier and Minnick. I'm your host, Steve Minnick.
And this is Dave Altmaier.
And this is the show where you're learning to be smart about the health of your wealth. Well, today we're learning to be smart about silver investing and perhaps gold or precious metals or mining. We have as our guest, for those that have just joined us, David Morgan. He is the publisher of The Morgan Report. It's a monthly e-newsletter. David has several copies of his book, The Silver Manifesto. We're giving those away to the first 3 callers. We have a limited supply of these, so we're only giving these away to the first 3 callers. But make sure you call in now, 32-SMART, that's 327-6278, or you will miss out on your opportunity to get a copy of these books. Well, David, I've got a lot of questions in the mailbag here, and one that has come up is, you seem to favor silver rather than gold. Now, is that true, and why is that true?
Well, basically, I like both precious metals. In fact, what I've taught from the beginning is that if you have a precious metals portfolio, and again, I want to go back that, this is an overall strategy for a portfolio. I've never been one to say, guns and gold and groceries, that's the only way to go. I think it should be diversified throughout the sector. I think there's a place for all asset classes. I think most people over-diversify. A 10% allocation of the precious metals is probably enough for most people. But if you're really, really concerned about the economic conditions worldwide and you want to up that, I'd say 20% is probably more than enough. And if I can digress just a moment, if you go back to Ibbotson and Associates of Chicago, they did a portfolio analysis about 10 years ago, and they looked at all asset classes. And what they discovered was that precious metals, not mining stocks, but precious metals themselves, were the best thing to have through all economic conditions. Let me repeat that. Through all economic conditions, you got a better portfolio strategy and better returns by owning precious metals. The allocation that they recommended is right between the two I just gave you. They recommended 15% into the precious metal sector in current economic conditions. So I come back. Gold is really a way to preserve wealth. I mean, gold over a long period of time holds its value. Certainly the price goes up and down, and sometimes it's overvalued and sometimes it's undervalued, just like any asset class. But over a long period of time, gold usually maintains its purchasing power. Silver, on the other hand, is a much smaller market and much more volatile. Silver can make you wealthy, or it can also put you in the poorhouse if you use too much leverage with it. So I like a balance between silver and gold. I think it's like investing in the stock market. You could think of gold as being a stalwart in the blue chips of the Dow Jones, and you could think of silver as being one of the up-and-comers in the NASDAQ. That's probably a pretty good analogy between the two metals. So if you're young, you're aggressive, and you want to make, want to play it that way, certainly you could favor silver over gold. If you're older, wiser, and you've had your hard knocks in the investing field, you might favor gold more. I think if you're gold only, you're missing a chance of silver to outperform gold, which I really think it will happen in the next leg up in the precious metals. But nonetheless, I don't tell anybody exactly what to do because one size doesn't fit all. Everyone's got a different risk-reward profile. So the summary of it is, I like both metals. I teach that you should own the precious metals, the metals themselves first. And once that's accomplished, then you can go into top-tier, unhedged, cash-rich mining companies, go down into the mid-tier, and then we certainly do speculations as well. But like most newsletter writers, I am different. I do not spend much money in the speculative sector. We say bet money you can afford to lose. It's a bet, not an investment. And we keep big money into big companies. And because of that, we've actually done quite well, even during these very trying times for the commodity sector.
Before we move on, what is the best place to buy silver and gold and to find the right price?
Well, there's several ways to do it. I mean, with the internet now, you can certainly just get on the internet and type in, buy silver, buy gold, and you'll get a plethora of different kinds of dealers. In fact, there's a website that was built by a friend of mine, and it used to be, it may still be there. It's called Gold Shark. I don't know why he came up with the name, but it's goldshark.com. And you put in what you want. So if you want to buy like Silver Eagle, you put that in the window, the search window on that website. Not talking Google now. You're on goldshark.com, and then you type in, Silver Eagle, and it'll compare all the prices for Silver Eagles. And I'll give you what the price is for one roll, for one box, and that kind of thing. Basically, I have a program that I'm an affiliate of called silver123.net, and that instills discipline. To me, silver and gold are real money and have been for thousands of years. It's a hedge position. It's something that everyone should have, but you don't need to overload in it. And this program, silver123.net, is one where you allocate a certain amount every month to buy gold or silver or both. You can allocate it how you want. And it instills things that I teach. One, at dollar cost average you into the market so you don't get all emotional whether you pick the bottom of the market or not. you have a long-term perspective, and it's something that once you set up and it takes about 10 minutes, it just goes on until you decide to stop. And it's very flexible. Let's say that you get a raise at work, or you come into a windfall, you could add to it if you wanted to, or let's say things are a little rough for you and you want to stop for 6 months, you can do that. It can be stored, but the company does send you the metal right away if you choose to do so. So it's something, again, that I'm affiliated with. I participate in it myself. They do not do any real mainstream advertising. They rely on the fact that they have such low premiums that you are going to be happy about the program, pass it on to your friends and neighbors, that type of thing. And that's how they basically get their advertising. And because of that, it gets even better. They do offer an affiliate program. So if you are going to use your mailing list or tell somebody about it, you can actually get a little bit of a premium. And I do mean a little bit, but still can add up over time. And it's something that's not a multi-level marketing system. It's just strictly dependent upon what you do on your own efforts. So something I like, something to consider. Mm-hmm. If there's a big purchase or something like that, and I've had those, of course, and I don't sell bullion, but I do consult. I've had some very interesting people over the years consult with me to buy silver or gold in size that want it in a certain location and that type of thing. And that's an individual case-by-case basis, so I really can't go into on the radio, but I do give that type of information if you require that. And that's not many people, but occasionally those situations do arise.
For the listeners that have just joined us, we have David Morgan, the self-proclaimed silver guru. And I think that's a good thing to proclaim, David. I think that makes a lot of sense. Having listened to you, I would call you the guru, and, that makes good sense to all of us. So what is a correct exposure to silver and gold, and why?
Well, I've been asked that question before, and I actually was asked to write in the Investing Rules book. It was a United Kingdom publication. And they had such notables as Sir John Templeton and many others of that class. Certainly, I wouldn't put myself into that category. But they asked different experts through mutual funds, master limited partnerships, mutual fund investing, and on. And they asked each one to write their 10 rules. So when it came to silver, they asked me. And the last rule, I said, too much of a good thing could be too much. And 10% allocation to the precious metals is probably enough for everybody. And later I revised that. This is before the Gulf War won. And I said, the way things are going with the war climate and the uncertainty in the economic field, we might be looking at upping it to 20%. But I say 10 still is probably the best for most people.
Good advice. Well, if you'd like to get more information, make sure you call us at 32SMART. That's 327-6278. And you can also send me an email if you have questions for David Morgan. That would be steve@smartwealthradio.com. Again, that's steve@smartwealthradio.com. And if you just turned on the radio, you now know that you might be able to get a copy of David's book, The Silver Manifesto, but we are giving the book away only to the first 3 callers. That's 32SMART, 327-6278. If you're outside the Spokane area, be sure to use that prefix 509-32SMART, and we'll be right back after these important announcements.
If you have some questions about your upcoming retirement or are not sure you are prepared for retirement, please give Steve or Dave a call. They can help answer your questions and provide a free consultation about your retirement preparedness. To set up a meeting time with Dave or Steve, call 32SMART. That's 327-6278. Make sure you are prepared for retirement and can survive the stock market roller coaster.
Welcome back to Smart Wealth Radio with Altmaier and Minnick. I'm your host, Steve Minnick.
And this is Dave Altmaier.
And this is the show where you're learning to be smart about the health of your wealth. We have as our guest today, David Morgan, and fascinating information that he's giving us about precious metals. When we were just off the air during the break, Dave Altmaier, my co-host, was asking David some questions. I said, wait, let's wait till we're back on the air. So Dave, go ahead and ask him.
So I heard at the end of last year that countries were repatriating their gold at a record amount. Can you speak to that? Is that true? And why do you think that might be, if it is?
Well, that's a mouthful, and I'll probably go through the rest of the show, but I'll try to be succinct, which is tough for me, but here goes. First of all, if you look at monetary history, which is something that's fascinated me from an early age, the old adage of the golden rule, he who owns the gold makes the rules, is really true. If you look back in modern history and you go to who, the sun never set on the British Empire, and when they, quote unquote, that empire, quote unquote, ruled the world, they had the most gold and the most commerce. And during their decline, the United States came to the fore with the most gold and the most commerce. And now we see gold shifting to Asia, primarily to China, although it's going into India and Russia as well. And certainly China is number 2 or number 1 recently as far as providing the most commerce. So the idea is that gold, even though the bankers play it down and negatively discuss it in the mainstream media, it really is the one asset that isn't a liability to anyone else in the monetary sphere, and they really do covet it, even though they pretend not to. I want to go a little bit further and explain the most important way to think of it is if you think about the Bank of International Settlements. The BIS is the banker's bank. And if you go back as far as just maybe a decade or a decade and a half ago, when they did the accounting for all the major banks of the world, they accounted in one way and one way only, and that was their gold holdings. They didn't care about foreign exchange. They didn't care about the bonds held. They didn't care about bank-to-bank swaps. They didn't care about interest rate loans. They didn't care about anything but gold. That tells you a lot. Now, they stopped that quite some time ago because if you listen to the whole show, you realize what I said about people not understanding the exponential function and what happens on compounded interest rates that cannot be sustained forever. Bankers know that as well as anybody. That's part of the reason we have the zero interest rate policy, but I digress and come back. So what's happened is, going with the BIS statement, is these countries have woken up and say, you know what, if you're holding my gold over at the Federal Reserve Bank in New York, I want it back. I want it because gold is gold and nothing replaces it. So this has been happening, this repatriation of gold from Venezuela. They got their gold back. Germany has asked for their gold back. Texas, for their pension fund, has asked for their gold back. And there are many other examples of places, people, hedge funds, and countries that want to put their hands on their gold. And this has caused a problem because there are so many paper claims, and it's a fancy word. All it means is there's multiple claims, but it's hypothecation and rehypothecation has taken place throughout the asset classes, through derivatives in every sector, stocks, bonds, but especially in the precious metals. And this is causing a problem because there is more gold on paper than there is physical gold. Countries are aware of this. Hedge fund managers are aware of this. People, particularly, especially the gold and silver bugs, are very aware of this. And now we're starting to get an actual accounting. I don't want to see a certificate that says I have gold. I want the real gold. So this is what's happening. It's the start of a gold run.
About 18, 19 months ago, Germany requested that Fort Knox return their gold. And they were told, no, we can't give that back to you right away. And then they said, well, can we at least see it? Nope, you can't see it right away. And then a couple of months later, they were given back their gold and in the right amount and weight, but it wasn't their gold. It would be like you going off to Iraq in the military and you leave your Camaro with your younger brother. And when you get back, well, it's the right year of Camaro. It's the right color. The interior looks the same, but the VIN number is different. And you go, well, where is my Camaro? Well, that's your Camaro, older brother. Not really. There is a story behind that. I don't know what the story is, but why is it that Germany couldn't get back the gold that was uniquely marked with their national symbol?
Well, a couple things to add on to, Steve. First of all, it was the New York Fed. And then also the Bundesbank said, or Deutsche Bank, I think it was, said, well, we'll give you 7 years to bring us back our gold. Now, this, to me, this is my speculation, so please don't take it as fact, that these bankers are sort of in bed together and sort of wink and nod and say, well, we've got the gold certificates, and over time. So they agree to take all their gold back over a 7-year time frame. But the first payment in gold did come through, as you said, Steve, exactly like you said. And the most important point is that it wasn't segregated. Segregated means that Camaro example is segregated from all the cars in the lot. And when I come home, that's the only Camaro I'm going to get. That's a segregated account, and that's what they're supposed to have, but that's not what happened. And why? As I go back to what I said earlier, this swap, this rehypothecation, someone probably used the German gold for a loan and then swapped it to another bank, and it got lost in the food chain, so to speak, and that gold cannot be determined as far as who owns it. So gold is gold, and I don't have a problem with that unless the contract says it's segregated, and then they can't produce it. That's a big problem, which is what is indicated here. I don't want to speak for Germany because I haven't seen the actual contract myself with my own eyes. The point being that they didn't get back what they put in. They did get gold back, and it's a minimum amount, really, compared to what they actually own. What the Fed holds for them is not, it's substantial, but is certainly not all of their ownership. But it really makes me wonder, why can't they, one, see their own gold, and two, get it back in a timely manner? Why have they agreed to take it back over a 7-year time frame in today's world, especially with everything that's going on with the euro? Are you kidding me? This begs further thinking and further questions, in my view.
I want to say something about gold, because you see these movies and they got these gold bars all over the place. But as I understand it, if you take all the gold in the world and put it together, it would fill about the size of an Olympic swimming pool. Is that correct?
3, 2.5. Yeah. The thing about gold that most people don't understand is the value. Now, when I was very young, once upon a time, and I bought silver, I bought gold, what most people don't realize, and this is an example, they have the absolute upside down idea about gold. They think that, if they're going to cash out all their wealth and put it in gold, that they're going to have to get a great big crane and get all this gold around. What they don't realize is that most people's net worth of everything that they own, houses, cars, automobiles, everything they own, could be put in their front 2 pockets and walk down the street if it was in gold coin. That's a truth. It was rather amazing to me when I first bought gold, because I went in, gold was about $300 an ounce at the time. I walked into the coin shop and I put in like $8,000, and I forget how many coins, you could do the math. But, I got a few gold coins, and this gal next to me was a little older than me. And the coin dealer said, look, and he put out a stack of 20 gold coins, and he said, that is a brand new Chevrolet. And then he put another stack of gold coins next to that, and he said, that is a Mercedes. And I'll never forget that as long as I live, because it was impacted me so profoundly that, again, you could put that in your front pocket, walk down the street, and you're carrying a Mercedes-Benz in your front pocket. Most people think that you get a lot of gold. No, you get a small amount. Why? Because it's precious. Look precious up in the dictionary. It's something that is just that. It's scarce, it's rare, it's hard to find. And as you said, Dave, all the gold in the world melted down would cover about 2.5 Olympic-sized swimming pools. I like to think of it like this. You think about how much oil there is in the world. So just go and do a thought experiment. You're on the moon, you got a big telescope, and you look down on Earth and you see how many gas stations there are. You would see quite a few gas stations. Uh-huh. But if you thought about it, you could hide all the gold in the world under about 5 gas stations of the entire planet. So that gives you a conception of the commodity oil versus the commodity gold as far as how rare it is versus a commodity that we're all very used to, which is oil.
Yeah. Great stuff. Well, thanks so much. I appreciate you being in the studio today, David.
Well, my pleasure. It was a great team to be in Spokane and come down to your studio and do the show. Thanks.
Thank you.
The information contained herein is not intended to be and shall not constitute an offer to sell, nor the solicitation of any offer to buy any security. Content is provided for information purposes only and is not to be treated as advice to make any specific investment. Please consult with an independent investment advisor before making an investment decision.